Hey guys, this is Kirk Hutchinson. I can get started if you guys don't mind. I know everybody has a tight schedule. So I mentioned this project to Michael Davis a while back, and we started talking about it. And I so Ray and I Ray Gabriel was also online. He's been working on this project for quite a long time, and he knows this project inside and out. So I'll turn it over to him here in a few minutes. But I just wanted to kind of show or tell everyone how the connection started. Obviously, Michael and we both attend the same church, and I see Pastor August is also online here. So that is the connection. So again, it's a
Hey,
real estate development, a multifamily,
hey, Kurt.
and
Hey,
yes.
Kurt. Kirk, I really want them to get an idea of like your history and your background as well. And I know it's Ray's project.
Hmm.
Most of the people on here, they're familiar with myself and Laquana. But can you
Okay.
just give them a little rundown as far as your bio and your level of expertise and experience in what we're doing here as well
Uh,
before we bring Ray in?
yeah, well, most definitely.
All right.
So my
Uh,
background is I'm a civil engineer by
uh,
trade.
uh, yeah, Kirk, one second, please.
Yeah.
Miss Laquana, can you go ahead and stop the share button so we can see faces?
Yeah, that's what I'm over here trying to figure out how to do.
Okay, just go ahead and stop
There
the
it
share
is.
button.
There it
There we
is.
go.
There it is. All right.
Gotcha.
Got it.
That's our
Thank you.
pastor.
So my background, my history. So I'm a civil engineer by trade, and I found a long time ago that civil engineers do not make much money. So I jumped to construction and then to real estate development. I started in Florida building condos, and now I'm here in Texas. And you name it, I can build it. Ray and I have been working together for a couple of years, Ray.
Yeah, about 3 years now. Yeah.
Yep. And we're currently working on two deals in San Antonio. One is in the city of San Antonio. One is in Cibolo, which is 15, 20 minutes away from San Antonio. But both projects are multifamily for rent. One is 444 units. The second one is 288. As far as I guess the areas that I've worked in, I worked in Florida, Georgia, Mid-Atlantic area. I've worked as far as Kansas City, Missouri area. Different climates, different personalities, different, you name it, I've seen it, or probably have seen it. But nothing surprised me anymore. And I've built from anything from, 2, 3 stories up to, I think the tallest building I ever built was 50, maybe 54, 55 stories. So, it's construction is tedious, but at the end of the day, it's very rewarding to walk away and look. I mean, I got some stuff behind me here of projects I've done, and it's very rewarding to walk away and just look back and say to myself, I was a part of building a pretty much a mini city because that's what it is. We've gone in and built, take a city block and just completely rebuilt it from nothing to 5 story, 6 story. And it's very rewarding. It's very satisfying for me. And especially when my family and I are in Florida. I've built a lot in Florida. And, driving up and down 95, whether it's in West Palm Beach, Miami, Fort Lauderdale, I mean, there's several tall buildings you can actually see from the highway. And it's very rewarding because my kids, my wife know that I've worked on those buildings. So it's extremely rewarding. So I'm gonna turn it over to Ray. I'm not much of a talker. Plus, I broke a tooth yesterday, so it's a struggle for me to speak right now. This project in the Heights is very exciting. Ray can go into all the details. It's ready to go. We're just looking for investors.
Yeah. Thank you, Kirk. Thanks for that. And thanks, Laquana, for having me and setting this up. I appreciate the audience. It's always fun to talk about this stuff with people who are interested in what we do. And so, yeah, I'll give a quick introduction to myself, and then I'll try and share my screen and talk about the deal itself. But I've been developing multifamily in Texas for about 12 years now. I'm an architect by trade. Spent the first few years of my career as an architect before, a little bit like Kirk, deciding I'd rather be the owner developer. And so I went back to school, went to business school, came out the other side of it, working for a number of developers, larger institutional scale developers, mostly around Texas. I've developed probably over 4,000 units of multifamily, Class A multifamily around Texas, a little bit in the Northeast as well. And I've recently, with a partner of mine, begun doing these smaller scale projects, these smaller scale deals on our own. And so we've come up with a product and a thesis that we believe is compelling. It can be competitive with a lot of the larger multifamily projects that you probably see around town, for a much smaller commitment and a lot less time involved. And so that's what I'm going to talk to you a little bit about today. If I can share my screen, I'll kind of flip through a short slide deck that I put together. Let me see if this will pop up. And I'm going to try to I'll stay high level here, and if anything, just stop me at any time if I've gone too fast or I need to explain anything in more detail. So
we're monitoring the chat. So if you have questions while Ray's going, just drop them in the chat, and I'll kind of help facilitate things. Go ahead, Ray.
Okay, great. So all right, so I think everyone can see that this is a project. Like we said, it's a multifamily project, which is to say it's a residential rental building. It's 197 units that we've designed on a piece of land that we closed on. My partner and I closed on back in April. Let me just touch briefly on my partners involved with this. Chris Hudson, who's not on the call this afternoon, but also has remarkable experience building pretty much everything, developing everything across Texas and Southern California. But we've been collaborating for years on various scale projects, and he's my partner in this project. And together we purchased this land back in April, and have been actively working on the pre-development of it. So this is a brief intro to our bios, but this is the site. So it's north of the Heights, the near north side. It's about a mile north of 610. Right here, it's 3.7 acres in two pieces of property that we've assembled. One is this. Can you all see my cursor? You seeing this move around? No,
it's just showing the title screen.
Oh,
the title slide. Yeah,
it's just showing the elevation, right?
Yeah.
Okay, so it's not showing me flip through the slides.
No, it's just showing Janice
All
Flats. Just that cover might have us on the wrong tab of screen.
Did it flip now?
Yeah.
Okay, sorry. So okay, this is what I was talking about a minute ago. This was the brief bio page that I was referring to. More info on myself and Chris and our backgrounds. But so you can see this now. You can see the map. So this is the pin, about a mile north of 610 and near north side. It's two pieces of property we assembled. Okay, so that's the blue. If you can see my cursor now, we've got the blue square here, and then this blue kind of whatever L-shaped, backwards L-shaped property that we've assembled. So this is right on the corner of a street called Janish and North Shepherd. So Shepherd's, very long, goes north-south all the way through Houston. So Shepherd is just over to the left-hand side of the screen where my cursor is now. There's been a lot of development in this area over the past few years. A lot of the larger institutional developers I mentioned a minute ago have been developing over here large properties, 300 plus units, structured parking. We have one that just opened up last December right on the corner of this street from us. And so there's a tremendous amount of demand up here for housing at every price point. And our thesis is to develop a slightly smaller scale project with units that we believe are just as nice, if not nicer, than what we're seeing developed in the submarket, but with a much more restrained, much more efficient building, which is to say we're not building huge, expensive amenities that you have to staff and pay for. And that will allow us to be much more competitive on rents and variabilize our costs and our rents with the market, right? And so we're taking a much more much more conservative approach to the way we're trying to compete with a lot of the larger developers over here. But tremendous amount of demand. I can go into this a little bit later if we want to talk about the target market and the demographics. But incomes and rents are reasonably strong here. A lot of demographic growth, kind of moving north from the heights as people are getting priced out, and we're trying to capture a lot of that. This is what we've designed. So it's 2 buildings. On the bottom right-hand corner, you can see this is a diagram of the site, the 3.7 acres. We've designed 2 buildings, 4 stories each, forms a courtyard in the middle. We've got a nice hard corner on the bottom right of the screen. That'll be our leasing office and our lobby. 2 elevators, 1 in each building, and surface parked throughout. Very light touch on amenities. If any of you have ever toured or lived in a lot of these buildings, you probably have noticed some of these amenity packages are staggering. 12,000 square feet of gym and clubhouse, huge pools, multiple pools sometimes, and frequently they're not used, right? They're showpieces, which people have to pay for though. And so again, the thesis is here: deliver units that are to market, if not better, without a lot of the extraneous expenses. So we've got, like I said, 197 units, studios, 1 and 2 bedrooms. To date, we have completed a permit set of drawings and are going through plan review with the city of Houston. We will probably be in a position to pull permits by the end of the year. Whether or not we do that will depend on timing with how we do with the rest of the capital raise. But that's the product. And again, we'll answer any questions on the details, the design, and the competition if we want to. These are two of the recent comps I was just mentioning. So much larger projects. Number 9 down here, the Dakota at Shepherd, is right on the corner of North Shepherd and Janish. It's literally a lot. It's two doors down. It's a big project. 250 some odd units, I believe. Their rents are, as you can, I don't know if you can read the chart, but the rents are averaging about $1,700 a foot or $2.11 a foot. Average rents in this entire area. This is just under a 5-mile radius. Average rents here are $2.24 a foot, or about, call it $1,900 a month. Our positioning relative to that, like I said, we're trying to stay below that. We're trying to come in less than that, right? Nice, just as nice of a product at a slightly competitive advantage. So $205 a foot, $1,600, $1,664 per month. The Roslyn, this project is under construction, or I think it's just about to open. They might even be under lease, started leasing now, but also not far, about a mile south of the site. Another large project, 384 units. So large amenity package and all the rest of it, and their opening rents are in the 220s. So just kind of a benchmark for comparison for what we're trying to do. I'll touch briefly and high level on the budget and what we're actually trying to do now. So to build this, it'll cost, these are round numbers, it's going to cost us $38 million. That includes everything. That's the land cost. That's the cost required to pay for all the designers and the consultants. It's the cost to finance it. So interest expenses and fees associated with that, permits, everything. So $38 million, it's about $195,000 a unit. We have, as I said, closed on the land. We own and control the land. And that was about, collectively between the 2 parcels, $4.7 million of that budget. So that's what we've spent a bit more than that to date. We are trying to raise in equity, which is to say cash, from investors, about 12.5 million. So if I can I'll just walk briefly through what's called the capital stack looks like, which means just the different funding sources for the project. So the $38 million, 21 million of it will be from a bank. It's a construction loan from a bank, just like you would, buy a house, right? Buy your mortgage, you get a mortgage. We have the land equity, or the land value, I should say, which is the 4.7 million. And we have we've got a $17.2 million equity check after the debt, of which 4.7 of that is land value of some means. And it leaves us about a $12.5 million cash equity gap to raise. So that's what we're endeavoring to do now with private investors. So what do you get for $12.5 million? The way these projects typically work is investors, whether it's an individual like yourselves or a large company who does this for a living with institutional grade money, will partner with the developer or the sponsor to take a limited partnership interest in the project. So what that means is you get your pro rata share of ownership in the project and in the project's profit and revenue if you decide to invest. And so these projects there's a number of different metrics that are used to evaluate potential profitability of these projects. I can talk about a few of them, but it's a 4-year project. You will put your money in usually right before we close a construction loan. In this case, it'll probably be 4 to 6 months from now. Your money will be invested for the duration of the project. So the construction lease up until we sell it. In this case, we're estimating that's going to be 4 years. And then you will receive your investment back plus your pro rata share of the upside. So in this case, we're expecting that the project level returns are just very simply, it's going to be a 2.2x, 2.2 multiple on your money. So in other words, you put $100 in, you get $220 out, $227 out at the end. That's just very high. That's just very high level. Now that's over 4 years. So the return isn't, 200% or 227%. The return is what I've indicated here, a 19% return, because it's factoring the time value of money and the duration risk. But that's very high level. That's just simply how an equity investment in a project like this would typically work. We are targeting, like I said, a little over $12 million in cash equity from additional investors. We will typically, for folks who are interested, we will typically send around a formal offering memorandum, an OM, which has all of this detail in it and more, all the risk factors, all the regulatory things that need to be disclosed. Interested investors will review it. Probably follow up with a number of questions, concerns, probably talk to their friends, families, lawyers, accountants, whomever they needed to. And eventually, if they do decide to move forward, we'll sign what's called a joinder or a subscription agreement, which is part of the investment memorandum. And then you'll wait for a capital call, which, as I said, will probably be about 6 months from now. I've kind of outlined the timeline. I've got a bigger version of this on the next slide. If I can switch, it's not letting me switch. So here's kind of the timeline, the next steps, as I was trying to explain a minute ago. So we're trying to secure our capital commitments, our equity commitments by the fall, by November. We have construction. We've got what's called indicative terms, indicative pricing from several construction lenders, banks, 2 banks, 1 life insurance company. We will go back to market with those probably in the next month or so and get them renewed. And so we've got some banks who are interested in making this loan. And that debt was the $21 million you saw on this page of debt. That represents about 55% of the cost. So we've got term sheets for a little higher than that, but that's conservatively what we're assuming we're going to move forward with, a 55% loan with a local bank. We will renew that and confirm that they can close that loan when we need. We're trying to get equity commitments, which is to say kind of a roll call of who wants to do this deal by November. And then we'd call capital by the end of the year with the hope that we could start construction a little bit depending on whenever we get our building permits shortly after that. We don't typically, you will not call capital and wait to start. You're gonna call capital within a week or two of starting the project. And so this is my blue sky scenario, if you will. It may slip into later into Q1, but that's the schedule right now. It will really depend on the permitting and how we do on the capitalization. So I started talking about this a minute ago, but prospective investors, when I talk to folks and when people think they might be interested, typically what we'll do is we will send the full offer memorandum, the OM, to the individual or to the group. We'll probably have some back and forth. They'll review it. We'll have some back and forth. We'll answer their questions. They will, if they're interested, we will send them what's called the company agreement, which is actually, this is the formal partnership agreement between you and me. A little bit like signing a purchase order if you were buying a stock. And you would sign that. You would sign the subscription agreement, which is to say how much you're going to invest, right? And then you would wait, like I said, you would wait for the capital call notice to go out in the next few months. The money, like I said, the money is tied up for 4 years, or in this case, it'll be 4 years. And so with a development project, there's really no cash flow until you sell it, until you're operational. So this is money that will be tied up in a liquid for 4 years, potentially. There's always a risk it goes a bit longer, but that's, it's not like an investment in a stock, right, where you can sell it at any time. I'm happy to go back and answer and kind of go into more detail on any one of these topics, but Michael or Laquan, tell me where you think I should focus or elaborate for the group.
Well, Ray, how much can individual invest in the project?
Well,
minimum.
We've done this two ways. There's not a minimum in the company agreement. There's not a minimum. Of the money we've raised to date, of the roughly $5 million we have to date, most investments have been in the low six-figure amount, $150,000 to $250,000. We have had in past deals smaller investments, but typically they will come through in the form of like a group of people, a group of friends will put their money together and form their own, LLC, and that entity will invest in the project. So in other words, if you had 10 friends who wanted to put $10,000 in, you could easily form an LLC online, get a tax ID number, open a bank account, put your, each of you put your $10,000 in there, and then that entity would be the investor. And the reason for that is at the scale we're operating at, it's incredibly labor intensive to administer, to deal with all the investor relations and the tax returns involved with small, multiple smaller retail investors. And so we've had a couple people do that in the past. Few people can easily form a partnership quickly, cheaply, and then fund that as a vehicle to come into a deal like this.
But what about the K1 return at the end of each year?
Yeah, so I included that in here just to, and I don't know if anyone's ever invested in a private placement deal. These are because of the nature of the deal, because you are a partner in the deal, you are what's referred to as a K1 investor. That's a form of tax return. It's just the name of the tax code, and that is kind of like a 1099, right? It's just another form of tax. Taxable income that you have to report. So every year, the partnership will issue K1s. That is just an acknowledgement of the money that you've put into the project. You don't pay taxes on it until you receive a profit, until you receive your money back in the profit. And after that happens, you will be subject to capital gains tax. Just like you would be if you sold a stock or if you whatever, sold your house, frankly, and didn't buy another one. And so K1s are pretty common for private placement deals. They're kind of annoying in the sense that they are typically always late. So people will have to file extensions with their taxes in April, but it's not a particularly big deal. It's just, when you do your taxes every year, you get a K1, you include it in your filing just like you would with any other tax form, 1099 or W-2 or anything like that.
So the bill cost per unit is what, 194 per unit?
That's right. So I can go back to this slide. So that our total development cost is $194,000 a unit. Average sales per unit in this submarket, in this area, $227,000 a unit, which is to say, when developers, owners go to sell those buildings, the average price for those buildings is $227,000 per unit. And what that means is we can develop a new building for a lot less than we could buy one for today, right? One of the highest ones is a project called North Post Oak, which is right here on the North Loop, which is a project I developed about 6 years ago. And we sold that for $227,000 a door back in 18 or 19. So to give you to put that into more perspective, the two projects that Kirk and I are developing now in San Antonio are all in development costs are about $230,000 a door. So just again, as a benchmark for comparison, we feel really good about our basis here, about our investment basis here, and our ability to get out to eventually sell it for quite a bit more than we built it for. Yeah, go ahead.
Well, I'm looking in the chat, seeing if anybody put any questions. So there are not any questions in the chat. So that means, Ray, you did a very thorough job of articulating.
Or people fell asleep. But we've got, so to the extent I'm happy to share this presentation, but I've got what's called a full offer memorandum that I'm also happy to share or send a link to if there's any sincere interest from anyone in this group, or if you might know folks who could be interested. And then, like I said, if after reviewing the OM, there's further interest, would love to speak again with folks, talk one-on-one if it'd be helpful, and then can ultimately go from there if there's a real strong level of interest.
Yeah. So if anybody's interested, I think kind of what the next steps probably look like, getting back with myself or Laquana, if you're interested from this particular call right here. We are recording it. There was a number of people that want to attend, but they just couldn't. So we're going to kind of send this information to them and follow up with them as well. So you guys can reach out to us and we can kind of coordinate some of these next steps that Ray's talking about if you want to explore it some more. Go ahead, Kirk.
So guys, just for context, a typical development would obviously include the bank funding the debt side, and most of the times institutional partners for the equity side. Based on what's going on right now with the market, it's pushing developers in a different direction, where most developers right now that I know of, they're actually doing what we're doing right now, which is friends and family, and putting together small funds, whether it's 50 grand or 100 grand, just to make deals work. I mean, we see, apartment buildings and different, commercial construction, whatever, starting, year over year for the last couple of years. But it's been a struggle to get the equity part of it. Once you get the equity part, the banks will fund. The banks will step in, but getting the equity right now, it doesn't matter which developer you are. I work with some of the biggest developers in this country, and it doesn't matter which developer it is. It's just very tough right now to get equity, put together equity. And the developers that I'm aware of, the developers I know, they're doing what we're doing right now. And they're having calls. It's a friends and family list. And I remember when I used to build condos in Florida, way back when, we would have our friends and family list just to be able to get a construction loan and, times a little bit different then, times a little bit different right now, but it's the same process. And we built a lot of condos in Florida. We got to the point where now the city actually, I think Broward-Dade and Palm Beach County actually mandate owning the condos for a year or 2 years before you can resell them. But for context, this is just a different time of raising money. But at the end of the day, companies are still building these apartments, and we're just trying to do what everybody else is trying to do, which is just friends and family trying to raise equity.
Yeah, it's a good point. You're exactly right. There's not a lot of large institutional grade money out there for projects right now. And that's a function of a lot of large investment firms are happy sitting on the sidelines where they can earn a really strong return at very little risk by buying treasuries. I mean, you have a risk-free rate of return now that's about 5%, right? So that's changing. It'll probably change going into next year as interest rates are compressing and treasuries have already moved. But in any event, you're right. There's also a much bigger benefit to individual, what's called retail investors, because they can, I neglected to mention this, they can benefit from depreciation on their own taxes by investing in what's called real property, real estate. So you invest $1 in an active real estate project, you get your pro rata share of that property's depreciation on your own taxes. I mean, that can be a meaningful tax incentive for folks. And many times larger companies just don't seem, it's not a motivation for them. And so
all right, we have one question in the chat to bring to your attention.
Sure.
Okay. So if all else fails, are the investors reimbursed? So if something happens with the deal or halts for whatever reason, what happens to the original investment money?
Yeah, so the equity is at risk. So if the project fails, if it goes bankrupt, the equity is at risk. The equity is at it's behind the construction loan. So the construction lender has a first lien on the property. They will find a way to get their money back if there's a catastrophic problem. The equity is at risk. The equity is ahead of me, though. The equity will have to get paid back. So there will not be a catastrophic loss, but let's pretend the market doesn't cooperate, right? Again, interest rates go crazy in 4 or 5 years. It's tough to sell, right? We don't want to hold on to it. We have to sell it at a loss, or even a minor loss. What that means is, the equity probably will get their money back. You might not make a huge return, if any, but I'm behind the equity, which is to say I only make money. I only get my money back and make my profit after the bank and the limited partners recoup their money, right? So I'm the first dollar in and I'm the last dollar out. But just be very clear, the equity, just like any other equity investment, like a stock, is at risk, right? If the company invested in goes bankrupt or whatever, your investment's gone. Hopefully you can recoup something, but that's a big distinction between the debt and the equity component.
Well, maybe what are some of the risks that we usually face in development?
Yeah.
Most of the risks that I face, it's most of the times covered by insurance. Whether it's a storm or whatever the case, a fire, whatever the case may be. So if it's something like that, then it's the insurance. We pay deductible. We have to carry what's considered builder's risk. So for us to build any project, the bank will require a builder's risk policy in place. That policy will, most of the times depends on the coverages, range from $25,000 to $50,000 in deductible. We'll pay the deductible, and the insurance company will make us whole. So the project continues, maybe delayed, but it continues. So beyond that type of risk, then it's force majeure, which is act of God. Can't do anything about it. But again, a builder's risk will cover most force majeure. So Ray, you can expand and figure out what type of risks other than fire, flood, hurricane, especially in the Houston area. Force majeure where there's labor shortage, you can't get labor to finish a project. Material shortages, you can't get material to finish a project, which those things are all overcome, can be overcome.
Yeah, I mean, Kirk's touching on really the catastrophic things like a total loss, right? Which, like you said, is dealt with very thoroughly by the lenders and the insurance companies. But there is definitely risk in terms of executing on the pro forma projections we talked. That feedback on my side. Yeah, there's definitely risk. There's definitely risk as far as broader market things go. There's interest rate risk, right? Like I said a minute ago, if we're trying to sell this in year 4 and interest rates really spike, all of a sudden the market for potential buyers is going to get pretty narrow, right? It's going to be tough to sell it. There's general market risk with rents and employment, right? We could go through a major recession in 3 years when we're trying to open this thing, or 2 years when we're trying to open this thing, and nobody has a job and rents have to compress, right? That's a risk. These are broader macro level risks. Now we can't get our 205, we're getting $1.90 rent, right? These are things that might happen. There's regulatory risk. There's always the risk that the city or the state one day is going to come back when we build the thing, is going to make us, I don't know, come back and do something crazy, like I don't know, I'm making it up, add a windmill to the thing, and all of a sudden that's another $1 million we have to spend, right? So there's a lot macro level risks that impact everyone. Do I think, or have I ever seen things like that impact a deal such that it's a total loss? No, they're all overcome. You're all able to overcome them, and we carry in the budget a meaningful amount of contingency for just those reasons. If we need contingency dollars to carry the project for a little longer and fund additional interest payments, if we have construction issues during construction, like Kirk was talking about, and we have an extra $100,000 on for something because there's a delay in drywall, we have contingency dollars for that. So we try to mitigate these risks as best we can, but the macro level stuff is definitely not. Yeah, go ahead.
Okay, sorry about that. So if, say, the group of people invest $50,000 into the project, are they able to obtain their own insurance policy outside of your policy coverage that covers? It's in the way. This is in the way.
It doesn't work.
Okay, so the insurance policy that you have covers you guys, but can the groups that come in also obtain their own insurance coverage for their money? And then do you have any suggestions on how they're able to protect themselves?
Yeah, no, that's an interesting question. So no, an investor wouldn't be able to get a property insurance or a builder's risk insurance policy on the project. But let's go back to the catastrophic loss, Sarah, that Kirk was talking about. The building burns down or something, right? We would have two options. We would take the payout from the insurance company and distribute the money back to the investors. The bank would get theirs back, and then investors get theirs back. You're not going to make a profit, but you're going to get your money back. Or we take the money and rebuild it, right? And we try again. But I don't believe there's a way for an LP, for a limited partner, to take out a property insurance policy on the project.
And can I hop in, Ray?
Yeah.
All right. And then, obviously another thing as an investor, and again, just kind of being like total transparency. If, Ray and Kirk on here and they're just kind of not legit, then that's another way. But, that's why we're going through showing their level of capability. We're going to vet them as individuals and as a group as well, to kind of cover that level of catastrophic loss. If they're just, if they're scamming, things like that. So that's another opportunity. But here's the thing. Number one, and I'm just going to speak from a real estate base and a local market base, right? So that's our expertise as real estate professionals. The city of Houston is really in an issue where it needs affordable housing. Like that's been the talk of the town for years. It's still an issue. And when we're looking at the unit rental prices comparatively to the area that they're building in, these are somewhat affordable units. right? So the city of Houston, and I don't know if y'all have already gotten this from the permitting department, they're probably applauding you all for the project because it's contributing to a problem that the city has. Now, as it relates to interest rates, we are seeing a trend where things are adjusting. I think the Fed just announced today that they do plan on dropping rates in their September 18th meeting. So running into a situation to where we're priced out the market from an interest rate standpoint, I don't necessarily see that for happening either, because we're seeing the Fed and the markets in need of the interest rate to go down because it's caused such a strain on affordability, not just in what we are doing here, but also just people trying to be able to purchase homes. So those two things that Ray brought up, obviously there are no guarantees, but I feel good that we're in a position to where those are going to be a non-issue. I just wanted to throw my little two piece in there, Ray.
No, I appreciate that. It's a good point. If we were having this conversation 2 years ago, 2.5 years ago, and we started this deal, whoever asked that question you're right though. We would have been in a much different scenario because we would have started this project with much lower interest rates. We would have capitalized the interest reserve it would have been undercapitalized. Interest rates would have spiked during construction, and we would have been having to fund that additional interest into the project. It happened all over the country, all over the world, right? Projects were really feeling the pinch with rising interest rates. We're in the inverse scenario now, where we're starting this project in the next few months, closing a loan, hopefully in the next few months, as rates are starting to soften. And so, to Michael's point, that risk is mitigated, and we've been spoiled for the past 12 years that nobody's ever really had to think about seriously spiking interest rates. And so, to be quite honest, the past 2 years, the first time in my career, I've had to deal with that. They've been low since 2008, since 2009. And so, it's a macro risk that everyone's got to keep an eye on.
Those are good questions, though. Keep them coming. Let's see. So we don't have any other questions in the chat. Anybody else have any questions?
So we had about 3 new people just join. So just to let you guys know, this is being recorded, so it'll be sent out for those of you that have just joined the meeting.
We'll definitely send this out to everyone. And again, thank you for Ray. Thank you, Kirk. Thank you for the opportunity for people to get exposed to what you all are doing. Like I said, just speaking from a standpoint of the city is definitely needed. We need more available and affordable housing units in the city. Although I am an advocate for single family home and single family housing, but this is a great opportunity for those that are in that interim to have some level of affordability in their housing costs. So appreciate you for that. I appreciate everybody for spending a little bit of their time this evening learning more about it. And like I said before, if anybody has any level of interest, then reach back out to us, and between myself and LaQuana, we can kind of facilitate next steps on everything. So again,
Mike, if you don't mind,
absolutely.
There might be some individuals, when you said that you and LaQuana are going to take the clearinghouse chair. Explain me exactly what that is, you being a business owner. Are you guys a registered agent of the investor pool? Or because, I might have somebody that might want to just kind of talk directly to Ray, and how do they get Ray's information? Because sometimes you guys are in a total different business than Ray. And so we're talking about investing in this property. Now, unless you guys have some collaborated MOU with Ray, personal investors and even nonprofits or business go directly to those individuals who are making those decisions. And so I just wanted to find out, what is the role of your real estate firm, your broker firm, and when it comes to Ray, and can people just directly go to Ray? Because when people invest, especially on a private level, especially within our church body, there is a level of I won't say secrecy, but confidentiality, that people don't let everybody know what their business is?
Yeah. No, I think that's an excellent question, Pastor. So all I'm referencing is that if anybody's interested in learning more, then just reach out to us initially, and then we can just kind of facilitate those connections. That's all I'm saying.
Yeah, they've
So
got
I'm
Okay,
not.
they've got my contact info, and they can
yeah,
they
but
can.
what I'm saying though, then once they talk to you and Laquana, then you got to go talk to Ray, and then you got to get back with them. That seemed to be a waste of time.
I got you. I
Now,
understand, Pastor.
unless you guys are actually setting up as a pool house where you say, listen, Laquana and I, our company, our individual, we're looking for people to pool with us to raise X amount of dollars. We're going to do an LLC, and we want to pool. Now, if you're doing that, then you need to say that. Otherwise, people need to go directly to
That's
Ray.
right. Yeah, you're right about that. You're right. If people are just making smaller individual, that's right. They would have to come directly to me, and I'd give them, a dozen. I'd go to a dozen people and give them the OM and the company agreement and everything. If it's just Michael and Laquana, you're right. It would be you would represent an investor group.
Absolutely. Yeah, so now I understand. I hear and I understand everything that you're saying, Pastor. So what I'm saying is that right now we don't have an idea of anybody's level of interest in any of this. So this was just a level to expose it to people. So all I'm saying is that since we put it together and we brought everybody into the room to expose it to people, then we're just asking for people to reach out to us, let us know their level of interest. Because if somebody is interested in kind of pulling their money together, as well as my wife, as we're looking at it, we may be interested in doing that. And so there's opportunity there. Somebody may just be wanting to go and do it individually. So we still want to have that phase where we kind of have that conversation and vet through things from this meeting to the next phase.
Okay,
I
well,
understand what you're saying.
I guess the easy thing for me, for the people that are listening, would be that you can say, well, Laquana and I will be investing in this project, and we're going to do the due diligence to get the Q's and A's done. So if you have questions, because we're going to personally commit to certain levels that you don't have to share with anybody, and that makes it easier than just like anything else, than somebody just actually just being a go-between and they're not even investing in the property or the work. To me, that's just a waste of time.
Oh yeah, no, absolutely. My wife and I are taking a serious look as being one of the investors in this project as well.
Okay, well, for me, my only question I had, we got a lot going on ourselves, but and I guess it goes to Ray, based on not just the individual. I know you have institutions and different companies that might. What about nonprofits? If a nonprofit organization decides to listen, I want to take a little bit of our reserve and invest in this project, and I'm mainly concerned about when you mentioned the W-9 or the tax ramification on a nonprofit. If you have some experience in that, I'd like to hear about that.
Well, I've never, so we have done deals in the past with endowments, which are nonprofits. That would be, they also are K1 investors. How they deal with their taxes on their side is probably different than how a private equity firm does, I'm sure. But it's still the same process. There's nothing legally from an endowment, from the Rice Endowment, for instance, which is a very active real estate investor, nothing preventing them legally, from the IRS to their founding charters, nothing that prevents them from doing that, or prevents me or another company from taking their money. So that's the only experience I have, though. I mean, for smaller local community charities, I don't think there would be either. I think it would have to do mostly with that company's mandate. What are they chartered to do, right? So that's the best answer I can give right now. But it's a good question for perhaps a tax advisor.
Okay, well, I appreciate that. Michael and Laquana, I appreciate you guys gathering this together. But one of the things I like to do, because of course we have a bigger platform of people because of the church size that we have, and just on the other project that we have on the table. I am having a meeting on next Monday for those who are interested in looking at some work we're doing and as investors. So that's what I was trying to get some clarity. That's why I did come on. But we are, and we can, you know, from a personal perspective, we can put some dollars on the table if you would set a goal. And if you and Laquana would be willing to set up the LLC and set a goal of what you're trying to raise that we can put into this pot or this pool, I'll be interested in that. But that way you and Laquana could definitely keep your eyes on the pulse and be that particular entity that keep those investors informed.
Yeah, no, absolutely. We definitely be interested in that and talking through that. So great idea, Pastor.
Okay. Okay. Well, thank you so much.
No,
Thank you, everybody.
absolutely.
Appreciate
Thank
the
you,
time.
Pastor.
Thanks for giving me the opportunity tonight.
No, thank you,
No
Ray.
problem.
Thank you so much. Kirk, thank you. If anybody has any questions after we wrap up here, like I said, let's connect. Let's get with us. We, like I mentioned, the pastor, this is something that a project that we're looking at as well as far as investing. So it's pulling money together so we can come in and have a certain position. That's something that we're open to. So just reach out to us. Let's talk about what we need to do next. Thanks, everybody.
Thanks, everyone. Good night.
All right.